The most expensive part of a breakout trade often happens before the breakout has actually proved anything. You see price press against a level, momentum begins to build, and you enter because you do not want to be late. Then the market pushes through just far enough to validate your decision, and reverses. What hurts is not only the loss. It is realizing that you were right about the level, but wrong about when the market had earned your participation. That distinction matters. A breakout is not confirmed simply because price crosses a line. A level on a chart is only a location. What matters is how the market behaves once that location is challenged. Does price move through the level and remain accepted beyond it? Does the market attract continued participation, or does the move immediately meet rejection? Does the breakout create expansion, or does it expose traders who entered too early? Your job is not to predict which side will win before the contest begins. Your job is to observe what happens when the market reaches the place where a decision must be made. This is where impatience becomes expensive. A trader sees price approaching resistance and thinks, if I wait for confirmation, I will lose the best entry. So he enters early. But the slightly better price comes with a hidden cost. He has accepted more uncertainty. He is no longer responding to evidence. He is paying for the privilege of being first. Sometimes that works. Markets are uncertain, and no confirmation removes risk. But there is an important difference between entering, because price might break out, and entering, because the behavior after the break begins to show that buyers are actually controlling the area. Watch what happens around the level. A strong breakout should not merely touch new territory. It should show that the old boundary is losing its authority. Price may close beyond it. A pullback may fail to reclaim the old range. Selling pressure may appear but produce little downward progress. Traders who expected immediate rejection may find themselves trapped, and their exits can add fuel to the move. The opposite behavior deserves equal attention. If price breaks above resistance and quickly falls back inside the prior range, that is information. If repeated attempts cannot hold outside the level, that is information. If the breakout requires constant aggressive buying just to prevent price from collapsing back through the boundary, that is information too. You are not looking for certainty. You are looking for evidence that the market is accepting the breakout rather than merely visiting it, and that changes the entire question. Instead of asking, is price breaking out? You begin asking, what must happen after the break before this move deserves my risk? Because the real confirmation is often found in what the market does next. And there are several specific behaviors that separate a breakout worth it. Studying from one that is already beginning to fail. The moment price crosses a level, your mind wants to declare the decision made. Resistance has broken. The trade is active. The opportunity is here. But the market has only done one thing. It has traded beyond a line. That distinction is small on the chart and enormous in practice. A price level is not a locked door. It is simply an area where traders have previously acted with enough force to matter. When price moves through it, you know the old boundary has been challenged. You do not yet know whether the challenge has changed anything. This is where traders confuse movement with evidence. A fast push looks convincing because speed creates emotional certainty. A large candle looks important because distance feels like commitment. But neither tells you by itself whether the market has established a new condition or merely produced a temporary excursion. So when you see the break, resist the urge to mentally complete the story. Ask only what the market has actually proved. Has it proved that the level was crossed? Yes. Has it proved that the breakout deserves your risk? Not yet. That discipline changes the way you watch price. You stop treating the first breach as permission and begin treating it as the beginning of an examination. The market has presented a claim. Your task is to see whether subsequent behavior supports it. And that raises the more uncomfortable question behind premature entries. Why does waiting for that evidence feel so difficult in the first place? You can know a breakout needs proof and still enter too soon. The reason is usually not confusion. It is the discomfort of imagining price leaving without you. That imagined move begins to control the decision. You picture the clean breakout, the fast continuation. the entry you could have had. Suddenly, waiting feels more dangerous than acting. Nothing in the market has improved, but your tolerance for uncertainty has fallen. This is how anticipated regret disguises itself as conviction. You are no longer asking whether the trade is ready. You are asking whether you can stand watching it move without you. Those are very different questions. The first is about evidence. The second is about emotion. And once that pressure takes control, an early entry feels reasonable because it seems to solve the problem immediately. You are in. You cannot miss it now. But relief is not confirmation. You have simply exchanged the discomfort of waiting for exposure to an outcome that has not yet proved itself. So notice the moment your thinking changes. If your reason for entering becomes, I need to get in before it runs. Pay attention. That sentence tells you more about your state of mind than about the market. The real test is whether you can let price move without treating every lost tick as a lost opportunity. Because once you stop demanding the first piece of the move, you can begin watching for something more useful, whether the market can actually remain where the breakout has taken it. A breakout becomes more interesting after the excitement fades. The first push may be sharp, clean, and convincing. But once price is beyond the level, a harder question appears: can the market actually remain there? That question matters because crossing a boundary and accepting new prices are not the same thing. A brief surge can carry price into unfamiliar territory. Staying there requires continued agreement from participants willing to trade at those higher prices. Watch the behavior after the break. Does price spend time above the level without being quickly forced back? Does movement begin to look normal there rather than strained and temporary? The longer the market can operate in the new area without surrendering it, the more meaningful that change becomes. You are observing whether the market treats the breakout zone as foreign ground or as a place where business can now be done. This requires patience because acceptance rarely announces itself with one dramatic signal. It develops through behavior. Price may pause. It may move sideways. It may hesitate without collapsing. Those quiet moments can matter because the market is testing whether opposition is strong enough to restore the old condition. So do not judge the breakout only by how far it traveled. Study where price is willing to remain. And if the market does begin to accept that new territory, the next test becomes even more revealing. What happens when price is forced to confront the old boundary again? A breakout tells you that price has moved through a boundary. A retest asks a harder question: has that boundary actually changed its role? Before the break, the level acted as resistance. Sellers were able to stop progress there. After price moves beyond it, a return to that area creates a fresh contest. The market is no longer testing whether buyers can break through. It is testing whether sellers can take control again. That difference matters. If price returns to the old level and selling pressure cannot push it decisively back into the prior range, you are seeing evidence that the balance has changed. The level that once rejected price may now be attracting buyers, or at least failing to attract enough sellers to restore the old condition. But do not turn this into a rigid rule that every breakout must retest. Some moves never return cleanly. Others retest too deeply to offer useful information. The value is not in the pattern itself. It is in the response. When the retest comes, watch what the opposing side is able to accomplish. Does pressure appear and produce real damage, or does it fade near the old boundary? A level proves its new role through behavior, not because a chart textbook says resistance should become support. And when that old boundary fails to hold its new role, the message changes completely, because a return into the prior range is no longer just hesitation. A failed breakout becomes dangerous when you keep treating it like a successful one that only needs more time. Price moves beyond the level, then slips back inside the old range. At that moment, the original evidence has changed. The return matters because the market has rejected the new territory. Buyers had a chance to establish control outside the boundary, and they could not maintain it. That failure creates a different set of pressures from the ones that existed before the break. Traders who entered on the breakout are now holding positions built on a condition that has weakened. Some begin to exit. Their selling can add pressure to the rejection. At the same time, traders who expected the level to hold may regain confidence because price has returned to familiar ground. The mistake is psychological. Once you have committed to the breakout story, you may start explaining away the failure. You call it noise, a shakeout, or temporary weakness, because changing your mind feels like admitting the trade was wrong. But the market does not care about the story you entered with. It only presents new information. So when price gives the level back, ask whether the reason for the trade still exists in the same form. Do not ask whether you still want the trade to work, because sometimes the most important confirmation is not that a breakout is strengthening, but that the market is beginning to show how much effort is required just to keep it alive. A breakout can look powerful simply because there is a great deal of activity around it. Orders are hitting, candles are moving, and the market appears busy. But activity is not the same as progress. What matters is what all that effort actually produces. If buyers repeatedly attack above the level and price advances easily, the market is responding efficiently to demand. But if aggressive buying keeps appearing while price struggles to gain distance, something different is happening. Supply is absorbing that effort. Buyers are working harder, yet receiving less movement in return. That imbalance between effort and result deserves attention. Think of two hypothetical breakouts. In the first, each push creates new ground and shallow hesitation. In the second, every advance requires another burst of buying merely to hold the same area. Both may appear active, but only one is converting pressure into progress. So watch the relationship, not the excitement. When participation increases, ask what price is accomplishing because of it. More effort should produce some meaningful result. If it does not, the apparent strength may be hiding resistance that is not obvious from the candle direction alone. This is why a busy breakout can sometimes be less convincing than a quieter one that moves with little opposition. And once you learn to see where effort is being wasted, another question becomes unavoidable, which traders are beginning to discover that their position is on the wrong side of that pressure. A breakout does more than move price. It changes who is under pressure. Before the level breaks, traders positioned against the move may feel comfortable. Sellers expect resistance to hold. Others may be waiting for rejection. But once price moves through that area and refuses to give them the reaction they expected, their position begins to carry a different kind of risk. That matters because losing traders eventually have to make decisions. A seller who expected an immediate reversal may tolerate a small move against him. If price keeps advancing, patience becomes discomfort, and discomfort can become forced action. To close a short position, he must buy. His exit now adds demand to the same move he originally expected to fail. This is why positioning can strengthen momentum after the initial break. The market is no longer moving only because new buyers are entering. It may also be moving because traders on the wrong side are being compelled to retreat. When you study a breakout, ask who is becoming vulnerable if price continues. Which group has built a thesis around the level holding? What action will they be forced to take if the thesis keeps deteriorating? The important point is not to guess where every trader is positioned. It is to recognize when continued movement creates pressure that can feed on itself. But even when that pressure confirms the direction, another problem remains. A move can be correct and still become too expensive to chase. A breakout can be completely valid and still offer a poor entry. That is one of the harder lessons in trading, because confirmation feels like permission. You waited. The move proved itself. Price is behaving well. Then, by the time your confidence is highest, the distance between the current price and the logical point of failure has become too large. The direction may still be right. The trade may no longer be attractive. This happens because confirmation improves your information, but price often charges you for that information. As uncertainty decreases, the market may already have traveled farther. If you enter simply because the breakout now looks obvious, you can end up risking a large distance for a move that has already spent part of its potential. So separate two decisions that traders often combine. Is this breakout genuine? And is this still a sensible place to participate? One can be yes while the other is no. That distinction protects you from turning patience into chasing. Waiting for evidence does not create an obligation to enter once the evidence appears. When price has already expanded, look at where your trade would be proven wrong and how far away that point now sits. If the structure demands more risk than the location justifies, the market may be offering clarity without opportunity. And that leads to the next question. Before you enter any confirmed breakout, what exactly would have to happen for you to admit that the trade thesis is no longer valid? A trade becomes dangerous when every new piece of evidence is allowed to mean whatever you need it to mean. Before entry, the setup can look clear. You know why the breakout interests you. But once money is at risk, judgment often becomes less precise. A move against you becomes temporary. A broken condition becomes noise. The thesis stretches because accepting invalidation feels harder than preserving hope. That is why confirmation must have an opposite. If certain market behavior gives you a reason to participate, then different behavior must be capable of removing that reason. Otherwise, you do not have a thesis. You have a preference. The important work is done before the position begins. Ask yourself what specific change would make the original logic no longer true. Not what amount of pain you can tolerate. Not how badly you want to stay in. What would the market have to do for the idea itself to lose validity? That distinction keeps the decision tied to evidence instead of emotion. When the condition changes, you do not need to invent a new explanation while the trade is moving against you. You already know what matters. A trader who only defines confirmation is prepared to enter. A trader who also defines disconfirmation is prepared to think clearly afterward. And once those conditions are known, the next challenge is arranging them in the right order, so the decision is made by sequence, not impulse. A good breakout decision is not one signal. It is an order of events. The trouble begins when you allow that order to change while price is moving. You see something encouraging, then mentally promote it into confirmation because you want the decision finished. The sequence collapses, and what was supposed to be observation becomes justification. A disciplined process works differently. You decide what must happen first, what must happen next, and what would cancel the idea before participation is even considered. Each condition has a place. Nothing is allowed to skip ahead simply because the market becomes exciting. That structure matters because emotions are strongest when events unfold quickly. Without a sequence, every new movement can feel urgent. With one, the question becomes simpler: has the market completed the next required step, or has it not? You are no longer trying to predict the entire move. You are allowing the market to earn your attention one condition at a time. This also prevents a common mistake: treating several incomplete observations as though they combine into one complete signal. 3 weak pieces of evidence do not become strong merely because they arrived together. The order still matters. So build the decision before the pressure arrives. Define the progression, then judge the market against it. And one of the first places that sequence is tested is surprisingly basic: whether you are reacting to a breakout while the evidence is still forming, or waiting to see where the market actually finishes. A breakout can look decisive while the candle is still forming, then look completely different when that same candle closes. That is the danger of unfinished evidence. During the bar, price may trade well beyond the level, creating the impression that the market has already made its decision. But until that period is complete, you are judging an event that is still changing. A temporary push can be caused by a burst of orders, stops being triggered, or a brief lack of opposition. The close tells you something more specific. After buyers and sellers had the full period to respond, where did price finally settle? That does not make every close reliable. It simply gives you a completed piece of information instead of a moving target. Watch how often your confidence rises with the highest point of the candle. If price is 10 ticks above resistance, you feel certain. If it closes only 1 tick above, the same breakout suddenly feels less convincing. The market did not deceive you. You judged the evidence before it was finished. So decide in advance what observation period matters to your setup, then allow that period to complete before giving its signal full weight, because even that discipline can be undermined if, while waiting, you quietly switch to a faster chart and find a smaller candle that tells you what you wanted to hear. A trader can begin with a clear setup on one time frame and still abandon its logic before the trade even starts. You identify resistance on the hourly chart. Price approaches it. Nothing has fully resolved. Then impatience sends you to the 5-minute chart, where a smaller pattern looks bullish enough to justify entry. The original setup has not confirmed. You have simply changed the measuring instrument. That matters, because each time frame answers a different question. A 5-minute move can be strong while the hourly structure remains undecided. The smaller chart may show local momentum, but it cannot automatically settle a condition defined on a larger scale. This is where time frame switching becomes psychological rather than analytical. You are no longer searching for clearer information. You are searching for permission. So decide which time frame owns the setup before price reaches the level. If the breakout thesis comes from the hourly chart, then the confirmation standard should remain anchored there unless your method explicitly defines another role for the lower time frame. Otherwise, you can always zoom in far enough to find something that agrees with you. The discipline is not refusing smaller charts. It is refusing to let them overrule the question that created the trade. And before the breakout even arrives, the chart that owns the setup is already revealing something important. Whether the level is still pushing price away, or whether that resistance is quietly losing its power. Before a breakout happens, the market often reveals weakness in the side that is supposed to stop it. Imagine price reaching resistance several times. On the first test, sellers push it away sharply. On the next, the decline is smaller. Then price returns again and barely retreats at all. The level has not broken, but something important has changed. Rejection is producing less result. That is information. A level matters because one side has been able to defend it. If that defense becomes less effective with each challenge, the chart is showing you a shift before the obvious move occurs. Buyers may not yet be strong enough to break through, but sellers are no longer creating the same distance. This is why compression near a boundary deserves attention. Price that keeps returning quickly, holds close to resistance, and refuses to back away is behaving differently from price that is repeatedly rejected with force. You are not predicting the breakout from that behavior. You are measuring the condition of the defense. Ask a simple question when sellers act here: what are they still able to accomplish? If the answer keeps shrinking, the balance may be changing before the level gives way. But that observation only matters if the boundary itself was meaningful to begin with, because a breakout through a level that never commanded real respect tells you very little. Not every line on a chart deserves the same respect. Some levels have repeatedly forced traders to make clear decisions. Others exist only because your eye can connect a few prices. That difference matters before you judge the breakout. If price has crossed back and forth through an area many times without consequence, another move through it may look important while changing very little. The market was never treating that price as a serious boundary in the first place. A meaningful level leaves evidence behind. Price reaches it and behavior changes. Advances stop. Reversals begin. Traders respond with enough force that the area becomes visible through repeated consequence, not merely repeated contact. So before asking whether a breakout is strong, ask whether the obstacle was real. This prevents a common analytical mistake, giving significance to the break simply because the candle is large or the line is obvious. A dramatic move through a weak boundary may contain less information than a modest move through a level that has repeatedly controlled price. Your attention should follow significance, not appearance. Study what happened when price met that area in the past. Did the market make decisions there, or did it simply pass through? Because even a well-defined boundary does not carry the same meaning in every environment. The next question is what kind of market is producing the breakout around it. A breakout pattern does not carry the same meaning in every market. In a directional market, price is already showing a willingness to continue moving one way. Pullbacks tend to resolve Progress is sustained, and new territory is accepted more easily. In that environment, a breakout may be part of an existing process. But place the same pattern inside a choppy, two-sided market, and its meaning changes. Price may push beyond a level, reverse, cross another boundary, then return again because neither side has lasting control. The breakout looks familiar, but the surrounding behavior is not. This is where traders get trapped by pattern recognition. You see the shape, so you assume the outcome should behave the way it did before. But patterns do not operate independently of the conditions around them. The practical question is not only, did price break the level? It is, what kind of market is producing this break? If the broader environment is orderly and directional, continuation has context behind it. If the market is rotational and unstable, a breakout may be only another swing inside disorder. So before giving the pattern authority, judge the environment that created it. And even when the market regime is favorable, one more detail can change the quality of the move completely. Who was actually participating when the breakout occurred? A breakout can travel a surprising distance when there is very little standing in its way. That is why distance alone can mislead you. During thin trading conditions, fewer orders may be available near the level. Price can move quickly, not because conviction is unusually strong, but because opposition is temporarily scarce. The chart still records movement. It does not explain how difficult that movement was to achieve. This matters because a breakout that occurs when participation is limited may face a very different test once normal activity returns. Traders who were absent during the initial move can introduce new orders, new opinions, and new resistance to prices that previously moved almost untouched. So pay attention to when the breakout occurs. Is it happening during an active part of the session, when the market is broadly engaged? Or is price escaping during a quiet period where a relatively small imbalance can create an exaggerated move? This does not mean thin. Session breakouts are automatically weak. Some continue strongly. The point is that you should not confuse easy movement with proven commitment. Ask what the market had to overcome to reach the new price. A move through heavy participation tells you something different from a move through an empty field. And once you begin judging who was present during the break, another question follows naturally. Was this strength confined to one chart, or was the wider market moving with it? A breakout can look strong on one chart while the surrounding market tells a very different story. Suppose one stock pushes through resistance, but its sector remains weak and related names are failing to advance. That does not automatically invalidate the move. Sometimes leadership begins with one instrument, but isolated strength asks a harder question. Is this breakout attracting broader participation, or carrying the entire burden alone? The distinction matters because markets often move through groups, themes, and shared flows of capital. When related instruments begin confirming the same direction, the breakout has support beyond its own chart. When they do not, the move may still succeed, but the evidence is narrower. This is where context can prevent false confidence. A trader can become so focused on a perfect, looking setup that he stops noticing whether anything around it agrees. Do not demand uniform confirmation from every related market. That would replace judgment with rigidity. Instead, compare behavior. Is your instrument unusually strong because it is leading, or is it merely detached from a weak environment that may eventually pull on it? Relative behavior should sharpen the question, not answer it for you. And even when the breakout is supported by its surroundings, there is another practical issue waiting just ahead. What if the move is real, but there is almost nowhere for price to go before it meets the next major obstacle? A breakout can be real, well confirmed, and still offer very little room to work. That problem appears when traders study only the level behind price. They see resistance broken and assume the path ahead is open, but markets are rarely that simple. Another prior high, congestion area, or major decision zone may sit only a short distance above. The breakout has solved one problem. It has not removed every obstacle. This changes how you interpret opportunity. A move through resistance may prove that buyers were strong enough to clear that boundary. But if the next important area is close, Those same buyers may soon face another concentration of supply. The breakout can remain valid while the available space becomes limited. So before treating confirmation as sufficient, look forward on the chart. Where did price previously stall? Where did strong reactions begin? Is the market entering open territory, or moving directly into another area where traders have already shown a willingness to act? The key distinction is between directional correctness and structural runway. Being right about the break does not automatically mean there is enough room for the trade to develop cleanly. That is why confirmation should never be judged in isolation from what lies ahead. And once you begin comparing several pieces of evidence around a breakout, another trap appears. Sometimes 5 confirming signals are not 5 independent reasons at all. A breakout can look heavily confirmed simply because several indicators turn bullish at the same time. Rises,